Okay, good morning, everybody, and welcome to the Daily Energy Markets podcast. It is, would you believe, December the 1st, 2023, and that's officially ho, ho, ho time. And the festive season, probably the bell's already rung on that. Brent crude oil trading down again this morning, not dramatically so yet in early trade in Asia, but $80.50 there or thereabouts. And clearly the big news overnight or the last 24 hours is the OPEC decision, which I'm not quite sure what exactly it is, except there was a headline number that said a lot of barrels, but with a lot of details missing. Let's go to the US this morning. Mike McGlone, senior macro strategist at Bloomberg Intelligence. It was a long labor, Mike, this meeting. It went on for at least a week. It was postponed last week, and the announcement, and finally they got to some kind of announcement yesterday. Your thoughts on the decision that OPEC made to announce the world and what it means for the markets?
I think the market's getting accustomed to more and more cuts from OPEC offsetting non-OPEC supply, which is greater, and the bigger risk of declining demand as the global market heads towards recession and deflation. Now, we're seeing that in the whole commodity complex. Industrial metals have bounced back a little bit, but they've been very weak this year. Grains are heavy, and gold is rallying. It's a very clear recessionary trajectory in commodities, and OPEC's just a small part of that. And you have to think about, every time I see these cuts, I have to think about what are their customers, China, Europe. Can they cut supply significantly if demand is that strong? And the answer is no. And the market's figuring it out that this is a pretty severe tilt towards bear market in all commodities. And crude oil is obviously a big part of it, but it's the macro that matters. Now, we have Europe's already in recession. China has a significant property crisis. U.S. it's a matter of time. It's been delayed, but it's a matter of time. Certainly, if you look at things like the curve and demand for diesel and gasoline and natural gas and corrugated boxes, they're all in recessions. And it was only a few months ago, most central banks are still tightening. So I think this is what we're seeing now is OPEC is becoming a smaller part of trying to do something that hasn't really worked in the past, trying to support a market that is heading towards a bearish trend. So right now, let's look at WTI this year. The lows around 65, the highs around 95. We're tilting towards the lower end of that range. And that question I asked myself is, we just had one of the best months ever for the stock market. What if we just get a little bit tilt lower in the stock market for a recession? Commodities are already telling us we're heading that way. And I think this is part of a deflationary domino. We basically need the stock market to stay up for commodities not to go down now.
Victor Yang, senior analyst, JLC Network Technology in China, which is where I suppose the big question mark, OPEC Plus meets trying to read the tea leaves on the outlook for China and China demand. We're seeing, Victor, factory activity in China continuing to decline month on month. What's the prognosis and the outlook for the Chinese economy and oil demand going into the new year?
Well, for the time being, the market still focused on the quota on the country's oil product exports and crude oil imports. And it's expected to release next year's quota at the end of this month, say for crude imports. And by then, people will judge further how the country's demand is for next year. And for now, the market is quite timid and tepid, I would say. And there's not much change yet because some still expect lower prices, lower crude prices. So the purchase is not strong yet for this moment. And for next year, demand is still expected to grow modestly from this year as we had another large refinery coming online. But it depends a lot on the prices too, as China has built up its stockpile this year, particularly in the first half of this year. So for next year, and as Mike said, declining real estate industry is one factor that is impacting the country's economy. And we still expect some trouble from this sector next year. So for the economy, a lot of international agencies forecast slower growth for next year. Say they forecast 4% to 5% growth for 2024, and instead of over 5% for 2023 on the whole. So this means they expect slower growth for next year, and this will also be reflected in the country's crude demand. We do not expect such fast growth in 2024. Yes.
Let's welcome John Odegaard Hansen, Vice President, Global Energy Systems at Rystad Energy. John, your first time joining us, it's a very appropriate time because given your expertise on the whole energy system and COP28 meeting today, and this just opened in Dubai yesterday. What are your expectations? First day announcement, a big deal on finally coming through with funds for the emerging economies. Your thoughts on where COP28 fits into the overall energy market narrative as we start to look towards a new year?
Thank you, Sean, and thanks for having me on the show. I think the things that we need to watch on in the COP28 meeting this year is really focusing on three main things. I think the first part is on the climate finance part, where we had this announcement yesterday on the loss and damages fund. This will be a key focus. Basically, the announcement now is.
I just want to interrupt you there, John. It got a standing ovation, but it seemed to me like that was over-egging the pudding. Was it of such a scale that warranted a standing ovation, this decision? I know it was sort of a big issue last year in Egypt.
You know, you're right, Sean. I mean, it was announced last year in Egypt that there will be such a loss and damage fund, and that was a big victory for some of these developing countries. I mean, the size of the fund is 420 million US dollars at the time. Some significant announcements from the UAE and Germany. I think there are still some questions here that needs to be answered in terms of what type of countries that can actually pull from this fund. That's not settled at this point, and some more practical stuff. But I think you need to see this as part of the bigger picture of climate finance, which I think we'll see many of these types of announcements during the COP28, and I think we just have started. This will come in different forms. It's also sort of on the financing mechanisms in terms of carbon markets, and I think some of these things will have an important impact going forward, because we really need to see sort of more investments also in the developing regions if we want to transition sort of the whole global energy system in the direction that the Paris Agreement is sort of requiring.
Mike, I wanted to pick up on the challenge that OPEC Plus faces, or that their decision. Clearly, they made an announcement indicating more cuts. The total amount of cuts, they call them voluntary, they're in the agreement, but ultimately, on paper at least, they add up to 5 million from whatever the base case was when they started cutting, and they added an extra 2+ million barrels to those cuts yesterday. But one of the growing challenges is the fact that we're seeing new supply come from other places outside of, OPEC Plus on this deal yesterday was only 8 countries. Within OPEC Plus, there's actually 23. So even within OPEC Plus, very few carrying the basket here. And then outside OPEC Plus, we've seen a big rise in the US this year. I think at record levels, above 13 million barrels of oil. And we're obviously seeing in Guyana and other places, Iran had a big year. My question ultimately, Mike, is that while OPEC tries to prop up the tent of their own, will these other producers stop? Will they recut as well? Will the economics and the politics see reductions in these other places where we saw big growth this year?
It's it reminds me, Sean, of a saying I've learned from grains and farmers. It's the higher price cure. We're the absolute wrong side of a typical cycle in commodities to expect supply decline, because it's the elasticity of the supply pump from last year. We pumped up WTI to $130 a barrel, a little bit more in Brent. And the average cost of production, the world's largest producer, the U.S., is $52, maybe 53, maybe 55. But it's a global phenomenon. But it's just that pendulum slinging cycle in commodities. We're in the back end of it now. Prices are still high. Production's just coming back on from all that big pumps in prices right now, and demand is not there. Certainly not in the U.S. Maybe in some places people are feeling SPRs. Victor maybe can comment on that in China. But it's the absolute wrong state of the cycle to expect global supply to decline. You're going to have to expect it to increase until prices reset lower and shut that off. It's just the way it has been working. Mostly in grains, it's a shorter term, but certainly in crude oil, about the last 15 years since the U.S. has really kicked up its production excess over supply. So there's a key metric I like to watch, Sean, is I take the U.S. And Canada excess of supply over demand, which is now almost 5 million barrels a day. That's all liquid fuels, includes ethanol. I obviously have a bit of a farm background. You add in OPEC spare capacity, and that's almost 12% of global production. 10 years ago, it was a major deficit. It was negative. So for me, that's where the tilt is right now. And I don't see anything that stops it unless we have some kind of significant easing and adding of liquidity from central banks, which is not happening, at least not yet, and or major fiscal stimulus. The tilt from a economic cycle and a crude oil and a commodity cycle is still very negative. We're basically in the early days of a bear market, the way I see it, and it's on the back of the big pump in prices from last year. I'll end with it's a higher price cure is showing up everywhere in all commodities, and crude oil is particularly one of them.
Victor, still digging into the idea of the outlook for China's demand, or at least China's import of oil. We've seen China over recent years and historically, but certainly evident in the recent years, a big appetite for importing oil and putting it into storage or whatever when prices are quite attractive. I mean, we're at $80 on Brent. The big news overnight from OPEC hasn't really changed that, at least not yet. Would these prices be attractive? I mean, typically we're going into we are in a big demand window for China with the Chinese New Year at the end of January. Would there be appetite to go into the market at these prices for the Chinas?
Well, I don't think they are attractive enough yet. Well, but for some, when they need feedstock, those who had not built up stockpiles much yet, they still need to make purchase, that's for sure. So that can support the country's demand to some degree. And for some others, they may choose to buy later on instead of at this moment. But on the whole, demand is still seen to grow modestly next year. And what the country is doing is now trying to restructure its industry. It has been doing so for years, and it's still pushing forward with this project. As you may know, in late October this year, the country announced that it would keep its oil refining capacity at no more than 1 billion, that's 20 million barrels per day by 2025.
Sorry, say that again. It announced what?
It would keep its refining capacity at no more than 1 billion metric ton per year. Which is 20 million barrels per day by 2025. And it would push forward with the goal to upgrade its industrial because of the dual carbon emissions and efforts to keep its energy consumption under control. Also because of its push for renewable energy too. So this will be further and in 2024, which will also make some impact on the country's crude demand.
And Victor, I mean, one of the things seems to be an expectation for, or at least you hear it talked a lot about over the course of this year and even before, I mean, that the Chinese government would engage in a big stimulus to sort of stimulate the economy coming out of the COVID dark days, as most economies in the world did, and America most spectacularly, still stimulating the economy, you would say, in America coming out of COVID. But China doesn't seem to have really bitten that. Some support here and there, but ultimately no big bazooka stimulus. Is that your reading on the situation? Could that still come?
Well, it has rolled out some stimuli, but not strong, very strong ones yet. And you can see from the country's GDP growth over the past 10 years also, it has actually been declining from about 2012 because of the government's efforts to restructure its industries, because some growth in the past, say at the beginning of the opening policy, was not sustainable. And the government realized that, and it needs to upgrade its industries, needs to transform its economy into green growth. So that's what the government has been doing. If we rolls out very large stimuli again, and it might have to go back to, counter some of the policies in the past few years and result in overcapacity again in some industries. That's not what is what it's doing to reduce over the past few years. So it's kind of a contradiction. So it has been moderating the stimuli instead just trying to get the economy grow fast. That's not what it's doing now.
John, what of the sort of feel as we come to the end of the year at OPEC, obviously with their meeting decision or announcement yesterday, and obviously they were sitting around the virtual table for the last week or two trying to come to some sort of decision. But you'd feel for them because ultimately it seems to me the market as a whole is kind of directionless at the moment. It's hard to tell what the world economy is going to look like next year. Is it the stock market seems to be on a tear again, but the direction of markets, it feels, John, like OPEC Plus, which had a very, very firm grip on the market through COVID, cut 10 million barrels a day. I mean, pretty dramatic grip on the market and the direction of travel over the COVID years and coming out of COVID. Feels like a little bit like they've lost that ability to steer the market. I'm wondering from Rystad's point of view, John, what is giving the biggest direction of travel for energy markets at the moment? Is it macro outlook? Is it managing supply? Is it geopolitics? Your thoughts on where all of those come together as we come to the end of the year, and feels like a moment that's very difficult to read where we go from here.
And no, I think you're totally right. And I think a lot of if you take the oil market, a lot of the fundamentals have really changed over just a few months. Because if you look at 2023 as a whole, the demand growth in the oil market is very strong. I mean, it's closer probably to 2.6 million barrels a day, which is significant growth. But then on the other hand, you have also like we talked about the U.S. supply growing 1 million barrels a day, which is sort of course, putting a squeeze onto OPEC. And then going sort of outside of the oil market too. I mean, we have this environment now with high inflation and high interest rates, which is really putting a toll on some of these renewable projects and clean tech projects because of their high capital costs. So obviously going into the next year, if we are able to see sort of some of these interest rates coming down, which is sort of what's perhaps being signaled by some of the major central banks, that could sort of ease a little bit, especially on the renewable deployment. And certainly, if you look in the 2030 timeframe, you really need to see an acceleration of all these renewable projects if you want to reach these climate goals that are set out. So it's a significant time period that we're about to enter now with next year and certainly the years that follows. And it's a bit hard to read sort of what's going to happen in this very short time frame.
Let's go to the survey question and get a view on this OPEC Plus decision. Has OPEC Plus cut enough real oil barrels in their decision yesterday to keep Brent at 80 and plus to counter the weak macro outlook in China, where factory activity continues to decline month after month? Has OPEC done enough to at least secure them 80 plus? Yes or no is the question here. Mike, just picking up on that last point, because it did the point that John makes regarding where we are in the monetary cycle. I mean, the markets, as you mentioned, equity markets are going, bonkers on the fact that the tightening is over, and actually are starting to see cuts, and yet obviously core inflation is still well above target. Where is that, do you think, as a factor going into the new year, that this could be a rate cutting year, and so markets and equity markets are very positive on that? Where does that relevance for commodities and oil, do you think, the tightening cycle or the plateau, the tightening cycle's over, if indeed it is? Your thoughts on that?
Well, the tightening cycle is clearly over. If they tighten more, it's just make things worse. And that was part of the problem with OPEC cuts back from the summer. It kept every central bank tightening in Q3, most of them, which is still a problem because we nearly haven't seen the effects. But it brings me back to another saying I've heard from grain farmers, and that is, when the bulls get turkey for Thanksgiving, bears get it for Christmas. And that's what I'm worried about in the stock market, because we've had one of the best Novembers ever for the S&P 500, and the market's already priced for the Santa Claus rally. And now, to me, the tilt is that we are on the cliff of deflation. As long as the U.S. stock market, it has to stay elevated. It has to lift all boats. If it just pulls back a little bit, the dominoes trickle downward. And I think what's happening now is the market's way too optimistic about Federal Reserve cuts. I mean, it's got almost 100 basis points cut priced into next year of cuts. And I think that's what's based on past.
You'd have to have a pretty deep recession. Sorry, you'd have to have a pretty deep recession to get 100 basis points.
There you go. And the difference is that the Federal Reserve and human nature and cycles are all against them cutting anytime soon, based on the risks of creating the inflation that they did when it cut and created too much liquidity last time. So this inflation, as you mentioned, levels are running around 4%. Their targets are 2%. Now everything is coming down, but they're supposed to come down in 3 sessions. PPI is running negative 0.4%. In the low this year is 0.3%. So I see severe deflation from commodities. And the key thing right now is the risk is, if equities get back to drop for a normal recession, which they almost always do, that is this time next year, we're going to be talking about deflation in crude oil WTI hitting $40 or $50 a barrel.
Victor, looking to the new year, the import quotas, for crude, the export quotas for products from China, do you expect them to be bigger? What's your outlook for the scale? We saw this year a few readjustments through the year. What's the sort of 2024 view on those items?
Well, China has cut its quota on crude oil imports for conventional independence over the past year, because of its efforts to integrate oil refining and chemical industries. And for next year, we had another large refinery, 400 KBD, coming online in the first half of the year, also a private one. So it's already starting to get quota on crude imports for next year. So we expect the country's crude quota to grow modestly next year. And for oil product exports, it's not expected to grow further because of the country's efforts to achieve its double emission targets and to keep its energy consumption under control. So domestic competition would be stronger.
Sorry, I seem to have lost you, Victor. Sorry, yes. Go ahead.
Refiners would be
you
under
cut
more
out there for a second.
Yeah. Yes.
Go
ahead. They would be under more pressure to find better, more distribution channels in the domestic market. And now state-owned refiners are under mounting pressure to integrate their oil refining and chemical industries to find better margins. So we'll see increasing integration into chemical. Yes. And this trend is now speeding up.
Just what about the access or the opportunity for discounted Russian and Iranian oil? That was a big opportunity for China this year. Do you expect that to continue?
Well, the discounts on Russian cargoes had weakened over the past 2 months also, and the imports of the Russian cargoes had dropped. So the cargoes from Russia may not be as attractive as in 2023. As for cargoes from Iranian, yes, it can be sold to more countries where the discounts can weaken too. And it's
the
not clear yet the
expectation.
pause, but yeah. Yes, but yes.
We're sorry, your line is cutting and I'm jumping in on top of you. So sorry about that. The imports of we're seeing announcements, Victor, of the US saying about tightening the ability of Iran to export or to violate its sanctions. Do you expect that to have any impact on the Chinese imports of Iranian oil going forward, that they will slow down or stop because of this US policy, or no?
Well, it won't impact China's imports from the country. And independents will still prefer such cargoes because of their cost. And they have been struggling to make a profit, so they would still prefer to choose such cargoes. Yes.
John, let's wrap up with you. Last word today on the issues of the sanctions on Russia and the talk in Europe about tightening them, and the idea of Denmark possibly playing a role to curtail energy flows out of Russia. I mean, one of the big stories again this year, I mean, the surprise of American oil production, if you like, getting above 13, but also Russia maintaining its exports across the world, seaborne exports growing globally this year. John, your thoughts on Russia's ability to continue to reach market with its products and its crude, despite the sanctions and the oil price cap and so forth?
Yeah, well, I think in the discussion in Europe has mostly focused on sort of the natural gas side of things, where only 30 BCM of the natural gas coming from Russia is still coming through the pipes, but there's still a lot of LNG coming into Europe. I think the discussion...
It's hard to really take the Europeans seriously when you see that still going on. I mean, not only gas pipe coming to Europe, but it's coming through Ukraine. I mean, it's somewhat absurd. There's a full-scale war on, and yet the gas pipeline's still flowing.
Yeah, I think the sort of the gas coming through Ukraine is one thing, but all the LNG coming on top here is sort of like perhaps a blind spot. I think that's probably another I don't know, 30 BCM there. So you have a significant or maybe more so significant volumes of LNG, and I think that hasn't been targeted yet through this sanctions. So I think that could be one interesting thing to follow, of course, depending on how the winter is turning out in Europe.
At the moment, though, John, Europe seems very well supplied for this winter. Storage is full. The winter hasn't been that cold yet. I see you're wearing a jacket in your nice groovy virtual office, but it doesn't seem like winter's really kicking the door down in Europe yet.
I mean, it's very early in the winter season right now, and I think if you sort of the 2022 sort of the situation in the power markets and the gas markets was very sort of tense. So I think we still have to go into the winter and see sort of what the temperatures are, but sort of the storage and at this point looks sort of good, but and also the LNG import capacities are also sort of strengthened from where we were before this crisis with Russia and Ukraine. So, but certainly something to follow and see how that can develop.
Well, we'll wrap it up there, our half hour together with Brent trading a little bit above 80, somewhat unaffected. Has OPEC cut enough real barrels to keep Brent above 80 plus? It seems this room thinks it has. We'll put that on social and see where it goes from there. The outlook for the direction of travel might take a few days for the market to absorb exactly this decision as we sort of look into the envelope as to exactly where cuts are and outlook goes. We've got obviously COP 28 in its second day and sort of a beginning of a long stretch here. This is a big weekend in Dubai. It is the UAE national holiday weekend, and we wish the UAE a very happy National Day, and they are obviously in the spotlight hosting this very important event. We'll be off air 3rd and 4th because of the holiday weekend, and back next week, and it'll be sort of interesting to see if there is a clarity by Tuesday when we're back in the chair as to what this OPEC Plus decision means. And the reporters on the ground in Africa, I'm particularly interested to see how Nigeria and Angola and other countries like that give some insights as to what decision they've made on this announcement. Iraq as well, and so forth. So it'll be interesting to get some of that insight over the coming days. But have a great weekend, everybody. Mike McGlone, as always, in the US. Really appreciate it. Victor Yang in China. Great to have your insights. And John Odegaard Hansen, really thank you for joining us, and we look forward to welcoming you back in the new year. All the best, everybody. Take care.
A nice holiday.
You too, Victor. Happy holidays.
Bye-bye.